committowealth.com, creating a legacy by committing to real estate wealth.
Welcome back to another episode of the Commit to Wealth podcast. With us today, we have Michael Becker. Michael is a co-founder and principal at SPI Advisory, where he has transacted on over 8,000 units worth over $1 billion of multifamily transactions throughout DFW and Austin. Based out of Dallas, Texas, Michael is responsible for all aspects of operations, including asset management, property management, oversight, accounting and taxation, capital improvements, and investor relations for SPI Advisory. Michael Becker, welcome to the show.
Hey, thanks for having me on. Well, I appreciate it.
Hey, it's a pleasure to have you on. So for those of my audience who don't know who you are, I don't know if there's anybody that doesn't know who you are, but for those of you that don't know who you are, I want you to maybe tell the audience, who is Michael Becker? Maybe tell us a little bit about your background and how everything got started.
Yeah. Well, thanks for having me on first off. And Michael Becker, I'm based in Dallas. So I grew up here, spent my entire life in the Dallas-Fort Worth area, and so I kind of got into the business by being a vendor. I was a banker, so I worked for some regional banks, and then our bank got bought by Wells Fargo in 2008. So I guess about 11 years or so ago, and then I kind of spent my last part of my career, my entire banking career, I focused on income-producing real estate. So I have a background lending on office, industrial, retail. The last 5 or so years of my banking career, all I did was value-add multifamily lending. So a lot of the stuff kind of coming out of the recession, I kind of built a bridge program out for Wells Fargo in my department. We just lent on all those broken properties, put a bridge loan on it, they go buy, renovate, fix them. So started out like a lot of people. 2011, I bought my first house. So I started out buying a 3-bed, 2-bath house in Mesquite, Texas for 75, 80 grand, put, 15 grand into it, rented it for $1,100 a month. And so started doing just kind of single family houses. Did that for about 2 years, ended up doing 16 of them. Just kind of realized it wasn't very scalable. And then kind of reflected back to what I was doing all day, every day at work, which was just loaning money to other people, and decided I was kind of on the wrong side of all those deals. So it was kind of better to be the borrower than the lender. So went out and, the last 6 years or so, we've bought about 8,000 units. Today we own 5,800 units, predominantly in North Texas, Dallas-Fort Worth area. We own 500 units in Tyler, which is like a small secondary market about an hour and a half or 2 hours east of Dallas. And then we own 900 units down in Austin as well. So I'm based in Dallas-Fort Worth. My business partner is based in Austin. So those are kind of the two markets that we predominantly focus on. I'm sure at some point we'll buy in Houston and San Antonio, but we haven't gotten there yet.
It'll happen. You guys are taking massive action. I think it'll happen for sure. So let me go back really quick. And so what was that the moment, maybe that trigger moment that kind of got you to say, what, I don't want to be a lender anymore. I want to be a borrower. What was that? Maybe that aha moment.
Yeah, there's really two things kind of happened. So in 2010, so my mom passed away in 2010. So I was in my early 30s, and so kind of was like a jolting moment for me where her and my father kind of worked their entire life, sacrificed, saved money to then have, great retirement one day. And then she had died before she could ever go and enjoy it. So kind of that was like a little turning point in my life where it's like, I within reason, I need to, I was making a bunch of money, doing a good job being an employee, living well below my means. But then, you never know how much time you really have in life. So it was kind of like a moment that I was like, okay, I can go out and take some risk. I need to go do something because, I don't know what tomorrow has. I need to take action today. That was kind of a real pivotal moment that kind of really got me unstuck from that kind of corporate mindset. And really the second thing was in early 2011, I was filing my 2010 tax returns. And I couldn't even itemize. Like I just had I had no tax breaks. I just had to take the standard deduction. And talking to my accountant at the time, he's like, there's nothing I can do for you. All you do is have a 401k and a W-2 job. You don't have any way. You need to either start a business or buy real estate. There's only way to kind of start saving money. And I just kind of reflected back to what I was doing at the bank, and I'm loaning millions and millions of dollars to these guys to buy these large scale projects. And you're looking at these guys' tax returns, and they all have like negative adjusted gross incomes because they have so much depreciation. And so they're making, a ton of money, not paying any tax. And it was just like, that was kind of the combination of those two things kind of back to back really kind of got me going. So what I did was I started the single family space, and I probably didn't really need to do that. I was a little gun shy because it was still pretty fresh to the kind of the big economic collapse. And a lot of people got some pain out of that. So I didn't want any partners. I wanted to put a little bit of money. These were kind of more bite-sized, $15,000 or $20,000 at a time. And I knew if I lost that, it wouldn't cripple me and I can kind of come back from it. So that's kind of why I started there. And it gave me some confidence with some project management skills and just kind of seeing a project from, broken, put it together, lease it out, refinance it. I did a bunch of that. So it kind of gave me some confidence there. But with the benefit of hindsight, I really didn't need to do that. I could have jumped right into the larger scale multifamily deals. But it's been, it's been one heck of a run. That's for sure.
Yeah, it has been. So it was more of a mindset shift that you had to take, and kind of perspective upon, what had happened, in different situations. And you're like, okay, I'm taking action. You started with single family, which was okay. The important piece was that you took action, right? So I think there's a lot of people out there that they're maybe are in that similar situation that you were a few years ago, but then they hesitate and they don't really pull that trigger, right? You pull the trigger. It was single family, but you still pull the trigger, and then you realize, hey, multifamily is just better, right? It's just a lot better. So that was, kind of that next moment. So maybe walk us through the first deal that you did, and then we'll kind of, talk about, maybe today, today's, we'll fast forward today, but talk about that first.
So I met my now business partner, 2011, I think it was. I made a loan to this guy from California, from LA, bought a property in suburban Dallas, and I fly out to go meet him. That's kind of how I met my now business partner. So at the time, he was working for a broker out of Beverly Hills that helped high net worth people from California buy properties in Texas. And so I made a loan to him, and then kind of switched their business model up along the way. And they realized that they really needed some like local boots on the ground, someone kind of in the market, put a little bit of money in and kind of asset manage the deal. While the person from California put a bunch of the money, put the vast majority of the money in, and kind of together you form a partnership, and then get the Fannie Mae loan and kind of do the deal. So that's kind of they were working with the guy, and he kind of ran out of money, and I knew that because he's one of my clients. So kind of raised my hands like I could do that. So ended up doing 4 deals that way before I left the bank and before we started SPI Advisory. So the first deal was in Garland, Texas. It was a 120 unit deal called Bay Island Apartments. I think we paid about $3.8 million, something like that for it. We probably put $400,000-$500,000 in capital into the deal, maybe a little bit more. And we sold it about 30 months. I think we owned it about 2.5 years for about $6.5 million. So, a little bit more than a double up on our equity. I think we had about $1.1 million. We had one equity partner in the deal. So it's kind of him and me. So I put in 5% of the money. He put in 95% of the money, and away we went. And so that was kind of the first deal. And we ended up 1031ing that to another deal that we paid about $6.5 million for. It's probably worth 13 today, which is crazy. We still own that one today. And so that same equity partner ended up doing 4 of our first 6 deals with us. Pretty much just him and us. So he's been a very valuable partner to us, which I asked him a few years ago after we've been successful, why the hell he gave us, basically half of his liquidity to do deals. And I thought it was kind of crazy at the time, but we needed the money. So I wasn't going to question him, but he just kind of believed in us, believed in the market, and it was, the right time. And he's done really well for himself.
Awesome, man. I love that. It's crazy how you went from that first deal, and you still made it a success, and then now to where you are today. It's just the crazy the journey that you've gone through, right? So we'll get there, but I want to maybe talk about today's market, right? So what is it how are you seeing deals today in each of the major markets? Maybe I know that you focus more on DFW and Austin. You got a couple of deals in Tyler. But kind of maybe do a little round of all the major markets, and maybe why you're not looking in San Antonio or you haven't bought anything in San Antonio or Houston.
Yeah, so we're early August 2019 as we record this, so it's been 8-9 years of the expansion cycle. So everything's up a bunch. I mean, I think the prices from like the bottom of especially the workforce housing pretty much almost tripled. Right. So, stuff that you could have bought for $25,000, $30,000 a unit are selling the 80s and 90,000 units on a pretty regular basis up here in Dallas-Fort Worth. I'm sure Houston, San Antonio are similar, and Austin's probably even more than Dallas on a percentage basis. So the prices have basically tripled. Rents have almost doubled. So, it's not just that prices have just gone up without the fundamentals going up. So, the income's way up. I mean, it's where if you could in 2010, there's a lot of decent located workforce housing you can rent for $600 a month. You can't rent a single, one bed for less than $900 a month now. It's just really hard unless you're kind of in a bad location in North Texas. So, so the fundamentals are strong. We started out, bought my first deal in 2013, Dallas-Fort Worth. You can buy a brand new Class A deal for about a 5 cap. A B deal was about 6.5 cap probably, and a C deal was somewhere between 8.5. You fast forward to today, an A deal is like a 4.75, a B deal is like a 5 cap, and a C deal is like 5.25 to 5.5. Then if there's like a bunch of upside in it, you lower those cap rates even more. So what used to be a 300 to 350 basis point spread between the top of the grade to the bottom of the grade, they're just basically on top of each other. I joke, but it's kind of real. Like everything's a 5 cap, regardless of quality, location, everything's a 5 cap. So that's kind of what is definitely different in the marketplace today than what it was, 6 years ago. We bought our first deal. So we've been, fortunate to have some successful properties, and now we've been kind of trading up in quality. That's kind of what we've been methodically selling, all the C stuff, and then we bought a bunch of B stuff, and now we're selling most of that. We sold quite a bit of it, buying mainly A minus. That's kind of what we primarily focus on. We'll buy a little older, we'll buy a little newer, but that's kind of my favorite part of the market. So kind of comparing and contrasting the 4 major metros and Texas. Houston, you understand a lot better than I do. I just don't get it. The city itself doesn't have zoning. You got weird stuff like that. You got all these locations that are not in the flood zone, but they flood all the time. So then you got a more concentrated economic environment. Energy is not as concentrated as it was in the 80s when there's a massive recession, but still a pretty large concentration within your economic base in Houston. So it's a little bit more higher highs and lower lows. You have a little bit more swings, and your debt isn't as good there because Fannie Mae and Freddie Mac are a little more cautious going to Houston relative to the 3 major Texas markets. So I just don't get it. And then your insurance is a little bit higher. But all in all, it seems like you guys had a glut of supply that kind of came through in 2015, right when the oil price was coming down. Supplies pulled back. So it seems like your market's kind of equalized a little bit more. But it's just not for me I just don't understand it. So we just try to stay away from it. But I think all in all, you guys have very similar population and job growth stats to North Texas and Dallas-Fort Worth. So I think long-term Houston is going to be just fine. It's seeing the same demographic shifts that a lot of the other parts of Texas and Florida and Arizona are getting. So I think it's good if you can pick the right place and know how to kind of manage it a little bit better than this guy would. San Antonio just seems kind of boring to me, so we just kind of avoided it. There's nothing necessarily wrong with it, but it's kind of slow and steady. It's only about an hour and a half or so south of downtown Austin. So it's about an hour and a half downtown to downtown, maybe a little less than that. But they just don't have the same dynamic growth and culture and environment that Austin has. So we've just kind of avoided that as well. It's just kind of slow and steady. So there's nothing necessarily wrong with it. Eventually we'll buy stuff there. It just kind of seems like everyone just does kind of okay there. No one's really kind of killed it too much as far as like the rental rate growth and things like that, at least the most recent few years. But it seems like a pretty fundamentally sound place. Austin, we got into about a year ago. Austin had a bunch of supply also kind of deliver in 14, 15. So I think they kind of got a little temporarily oversupplied, and it kind of paused for, a couple of years. And now it seems like it's back and it's on fire. And I think organic rental growth down in Austin as a whole is, near 5% or will be near 5% for 2019, which is, probably double the national average. So Austin seems like it's pretty dynamic. Now the ramping supply back up. But there's so many people moving there that it seems like it's being able to get absorbed so far. So all the supply they're delivering is getting absorbed, and everything we have down there is doing really, really well. So we're real bullish about Austin, because the demographics, and I'll give you some stats on Dallas-Fort Worth because it's the most familiar from population standpoint. But everything I'll tell you about Dallas-Fort Worth, Austin is growing on a faster basis from a percentage standpoint because it crossed over, I think, 2 million people in the metropolitan area in 2015. So I think it's about 2.2 million people today, give or take. So just the amount of population influx is just staggering. And the proportion of it is all younger. So like there's so many, Gen Z and millennials that live there. So, it's kind of the disproportionate to people that is generally in the renter cohort. So you get, just tremendous amount of demand for multifamily stock down there. And then Dallas-Fort Worth is the biggest market in the state, 4th biggest in the country. He's about to overtake Chicago in the next 15, 20 years as far as the 3rd largest in the country. Dallas-Fort Worth, if you were here in 2010, we had about 6.5 million people in Dallas-Fort Worth in 2010. Fast forward ending last year in 2018, I read the stat that there was about 7.5 million people. So in an 8-year span, Dallas-Fort Worth grew by 1 million people. And the projections are going forward that somewhere between 2030 and 2035, we're going to be about 10 million people. So that's another 2.5 million people, about a third of the population. So if you think about that, that's like to take the entire metropolitan area of Orlando or Charlotte and putting it on top of today's Dallas-Fort Worth as far as population. So I don't know much, but, I know that if you add, the entire population of Charlotte on top of Dallas, rents have to go higher. There's just no way they don't go higher. Now what we do well in Dallas is build a lot of apartments. So I think we're going to deliver somewhere around 30,000 units in 2019. That's been pretty consistent for many years. So we're just adding tons and tons and tons of supply. So far, it's all been absorbed pretty well. There's pockets. It's in town Fort Worth, in town Dallas, northern suburbs like Frisco, Plano. Up the tollway corridor, that's kind of where a lot of supply is being delivered. So if you kind of own away from the supply, you tend to do pretty well. And that's kind of it. I think generally speaking, Dallas-Fort Worth is kind of the monster. It's a very diverse economic base. Austin is not quite as diverse. You got some tech and government kind of and education concentrations there. But in my opinion, those are the two best markets within the state and amongst the two best across the country. I think you can argue there. It's hard to find another major market that's much better than these two. I know Phoenix is doing really well now, and Atlanta and a couple of these other places, Tampa Bay, I think have all been doing really, really well. But these kind of stack up right there with them, and we happen to be my backyard. So it's kind of an unfair business of kind of being in the market, getting to know the brokers pretty well. You kind of have a little edge over being kind of out of the market. So that's kind of what we decided to focus on.
I love that. Yeah. And so, it definitely, DFW is a strong market for you to be in. You're fortunate that you are in your backyard. You know the markets very well, like the back of your hand. And so, you're able to build a lot of relationships there, and so it's definitely, that's a recipe for success right there. Right. So I like that. So because we are at, who knows? We're maybe at the top of the market. We don't know where we're at, right? It's inevitable that something's going to happen, the few years or whatever. But what are you doing, today? Are you still aggressively looking for the next opportunity, aggressively looking for deals, aggressively submitting offers, or have you kind of slowed down and say, hey, my portfolio is where it's at. I've done well. Let's kind of slow down and just be very, very picky on the next opportunity.
Yeah, so we bought 5 deals this year so far. So we're still pretty active. We closed a deal last week and closed a deal the week before that. So we're still pretty active. We're just trying to be selective. I've always thought of myself as trying to be selective. So maybe I'm delusional and all come crumbling down one day. But we look at we look at everything. I try to look at everything like legitimately. Not saying I'm successful looking at everything, but we look at the majority of what's either on market or off market that's in the marketplaces. So that would send the kind of the target type properties that we want, which a couple hundred unit A, B to A minus kind of product. We look at pretty much everything that's possible out there. So we're just going through deal after deal after deal. The last deal we bought, we actually started working on about 18 months ago. We put an offer in. We almost had it awarded to us a little bit over a year ago, and then the seller kind of pulled back, and we just stayed on top of them. That was kind of one of what I would call a true off market. I don't think there was anyone else bidding on it. Most off market deals is kind of like a marketed process just without the formal OM and stuff like that. So the one before that was like that as well, where the broker was kind of selected to go market the deal. He didn't really kind of formally market it, but he picked the top 10, 15 type of buyers that would want to buy a 2009 vintage deal in that submarket that could do a $30+ million deal. So all the household names, if you're in the industry, that would buy this type of stuff, we're kind of in a knife fight with all of them to try to go win this deal. So it got competitive, and we had to end up we got awarded the deal. A couple of reasons why was, one, because it's probably our 15th or 16th deal with that broker. So we've had a very, long, successful relationship. He's one of my best buddies now at this point. It was the 3rd deal with that seller. So we bought 2 previous properties from the same seller. And then we passed through like $200,000 or $250,000 Vertus money. Didn't only go hard. We actually literally let it go from us to the title company to the seller's checking account the day we signed the contract. So we were pretty aggressive with our terms, and we knew that we could get that done. But that was our 38th deal or something like that we bought. So you don't do that on your first deal. You can do it when you're kind of have a little bit more experience and kind of know what's up. And that was a 5th or 6th loan we made with that same lender, so we knew our debt was in place. And really the question was, could we raise the capital or not raise the capital? And we felt pretty confident that we could.
So the majority of your deals today are more like the A type of deals, maybe B plus, maybe somewhere in that range, right?
Yeah, kind of mid to late 90s, about 2008, 2009. That's my favorite part of the marketplace right now. So I call that A minus. You might call it B plus. It's kind of semantics, but it's 15-20% cheaper on a nominal rent basis than what a brand new product next door would go at, because you just have cheaper finishings, and still have 9-foot ceilings. It still kind of looks similar, but those are all pretty much garden style, meaning you don't have structured parking, you don't have a parking garage, you just have garden surface parked deals, 3-story walk up, and they have like white appliances and cheap fixtures and carpet in the common area. So we come in and do a similar value add to what we would do on like an 80s deal, but we just do a little bit nicer finishings. Like we'll do the cabinet fronts and stainless steel appliances and backsplash. So instead of spending maybe $6,000 a door, we'll spend $7,500 a door or something like that, and kind of make it a little bit better finish out.
So if we had again, I'm talking about market correction. If we had a market correction, you're buying A deals right now, would you go back to like maybe, doing Bs, B minuses, something like that? If obviously the prices, they may go lower. So would you be open to going back to that asset class, or would you try to stay in A?
Yeah, we just bought a deal in the 70s deal 2 weeks ago in Tyler. So, I'm kind of agnostic to it. I mean, I prefer to have nicer, better stuff. It's just easier. You have less deferred maintenance. You have less recurring capital items that you have on the older stuff. So yeah, but as of right now, if I have to pay a 5 cap for a 2004 vintage deal and a 5 cap for a 1974 vintage deal, I'm going to buy a 2004 vintage deal, because the 2004 vintage deal, I can go in and swap out appliances, fixtures, flooring, just like I do with the 74 vintage deal. Just what I think with, rates ever go up, which are, as we're talking, they're plummeting right now. So I don't see that happening in the near intermediate term. But if rates go up and cap rates expand, I think that the better properties will be a little bit more sticky, lower, and I think the lower grade properties, the C stuff, the cap rates will expand faster. So I think that you have more risk from cap rate expansion the lower you are in the property grade. So Mike, you definitely have had a lot of success, right? So what would you say has been the biggest reason, or what do you attribute your success to? If you could give us maybe 1 or 2 reasons why you have been able to scale up so quickly. So I'm, I had a really good professional background. So, all I did all day was underwrite loans. So when I started in the business, I had a lot of experience. I had a lot of relationships as well. So, I knew all the brokers. So what I had to do was get my perception in the marketplace from being a banker into being a principal in these deals. So if you buy a couple of deals, it doesn't take very long for the marketplace to pay attention to you. So get a couple of deals done, then everyone thinks of you differently. So that was pretty easy to overcome, especially in 2013. It was a little easier to get opportunities awarded to you. It wasn't quite the competitive landscape like today is. But really, I think the reason for the success was, I had a really good base from an educational standpoint. So if you don't have that, you need to go get that. So not everyone is going to be a banker that makes, $100 million loans on apartment buildings, every year. So you got to maybe hire a mentor or join an education group or something along those lines. That's a good way to kind of shortcut your education. And then the second thing is, we just had a very insatiable drive to go out and, I left the bank. I was like 35 years old, about to be 41 now. And so when I was 35 years old, I was kind of, looking at the bank and looking at my boss and my boss's boss and his boss, and kind of looking at what my career path would look like if I stayed, and kind of got depressed. Like, I didn't want to be a big corporate banker and, go do meetings and all that crap that entailed. So it kind of felt like, it felt literal as a figurative fork in the road, but it felt literal to me. Like, it was like, if I stayed, every year I stayed, it's going to be that much harder. They give you stock options. They kind of handcuff you. You're going to leave more and more money on the table. So I felt like I was 35. Like, if I left and I failed, I can always go back and be a banker. I was a good banker. So they're going to need bankers no matter what. Good times or bad. It's either to make loans or work loans out. I can do both. But if I succeeded, it was going to be good. So I just had this drive. And then I was looking at the economy as like, 2010, 2011 was really rough. But by 2013, the prices were still pretty low. The cash rates were still pretty high, but the debt started loosening up and equity is a little bit easier to get. So it felt like I had, a multiple year runway that I can go out right then, right now. And it was my time to go out and make money. And that's kind of what it felt like. And that's exactly what we did.
So what would you say is your biggest roadblock or hurdle to maybe get to that next level, right? You've had a lot of success, but maybe you want to get to, 15, 20,000 units. What is it that you have to do in the next, 2, 3, 5 years, whatever, to try to get closer to that goal? If that's even a few years.
Yeah, a goal of ours is really we want to be between 8 and 10,000 units by the time we finish 2020. So a little bit less than a year and a half, and we're 5,800 today. So I'm pretty sure we'll make at least 8,000 at this pace. And so what we've decided to do would just be, just tenacious. We're continuing to buy deals. We're trying to buy, if we can, portfolios, if at all possible. So that's one thing we've done a couple like 2-packs where we buy 2 deals and, at once. We never bought 3 or more at one time. So it's at some point in the next, year, the goal is to buy, maybe 8 or 800 or 1,000 units at one time and just kind of do a portfolio. So we can, do it's a similar amount of work to do, a portfolio as it is a one-off deal. It's a similar amount of work to do a $40 million deal or a $4 million deal. So the bigger you can do, the easier it is to kind of scale up. So I think if we can pull off a portfolio, so I think really what it was we're probably one of the more successful people in taking syndication and scaling it, because we've not taken a lot of people that have a similar size to me take joint venture like private equity firms, institutional capital. So they'll put 5 or 10% of the money in as a sponsor. Maybe they raise part of that, and they get a single source equity check for 95 or 90% of capital. So it's just kind of more programmatic. It's a little easier to kind of work that way. The way we do it is we do it 100,000 at a time, and we just get a bunch of passive investors and kind of pool it together. So we've chosen to not take institutional capital. So we took institutional capital. I think we could grow a lot quicker, but there's a whole lot of stuff that comes with it. We've been successful in not having to pay a preferred return on all our deals. We never paid it. So I'm trying to avoid paying a preferred return, which is, kind of one of the main reasons why we've just done the syndicated route. And then the other thing is all these big institutional capitals will have a bunch of 25-year-old MBAs working for them that come and ask you on a weekly or monthly basis why you spent $700 on a line item instead of the $600 you guys budgeted that month, just to kind of justify the job and eat up a bunch of your time. So we're trying to avoid that as long as possible. So I think if as long as we continue to grow the database and we have the ability to raise capital, that's really kind of the biggest hindrance to us, because we've done a pretty good job of scaling our company internally. So I feel like we have some capacity internally with, we have a, high quality asset manager, that worked for a large ownership group managing 160 assets. Now he manages our 25 assets or whatever we have today. So I think he's got capacity. We have, administrative help. We have, legal help in place. We have accounting help in place. And then we have, the third-party management company, and they've been able to scale with us as well. So having all that kind of in place, I think we have the resources to scale. And if we needed to, we could always layer in more administrative help or more asset management help or whatever we needed to kind of as we grow the portfolio. So really it's just kind of, do we have the confidence that we can continue to raise capital in large chunks? 2 of the last probably 3 or 4 deals we did, we raised a $25 million equity check and $27 million. So we've been able to, and all that at 100,000 at a time. So we've been able to, do, like I said, do that at scale with the help of technology and staff and just kind of processes and procedures. So we're pretty organized from that standpoint. So can I do that at $30 or $40 million at a time? Because you got to bet $1 million in earnest money that you can go raise $40 million. That's kind of basically the trade that you have to do when you start buying these large deals. So that's kind of how much courage do I have to go out and bet $1 million like I raise 40, right? That's kind of the trade to be able to continue to grow and scale.
So it's definitely competitive out there. You see a lot of these the bigger guys, going after some of the same deals that you are going after, right? So, what is your competitive advantage, over those guys? How do you beat those guys?
Yeah, so one of the bidders on that deal I was telling you about in North Fort Worth we bought a couple months ago, that was like a knife fight. One of them was a very large institutional owner. They owned over 70,000 units, right? So they have a discretionary fund of $1 billion or some crazy number like that. And so it was them versus us, and we were there on the same kind of price. And so what I found, which was kind of surprising to me when we started bumping up against some of these people, is the more institutional, the larger the firm, they do not, within their mandate, they're not allowed to go with hard earnest money out of the gate. So that was like kind of surprising. So that's pretty common. I'm not saying like never, but like that's kind of a more common to not be able to do that than it is. So they have to have all these like boxes checked before they can go hard with earnest money, because they're formulaic, and they have an investment committee, and they have all these things to answer to. And so guys like us, like I just said, I could bet that I'll pass through $300,000 day one to win the contract. So this large group isn't willing to do that. We're similar prices. I own a bunch of stuff in the marketplace. I'm willing to pass through money. Me as a seller, I was like, well, screw the institution. I'll just go with this guy because this guy, is committed, right? He's going to figure it out. And if he doesn't figure it out, he's going to lose $300,000. So that is some of the things that a little bit more entrepreneurial or smaller firms like us, you just gotta take that kind of risk if you were competing against some of these people, because you can't compete against $1 billion discretionary fund that gives write a check day one or 30 days after they get an escrow, they just write a check and pay cash and worry about the debt later. We just don't have that kind of resources. So those are some of the things that we've been doing. And then just trying to get ahead of it, just get the brokers, brokers do business with people they know, like, and trust and have confidence can do the deal. So just making sure that you're always in front of them, top of mind, and you kind of get the opportunity maybe a little ahead of time, or maybe, just try to work those angles as best as possible.
Got it. Okay. So, you also talked about that you prefer to maybe raise it $100,000 at a time, right?
Yep.
Your equity, right? So you're not necessarily going after a family office or private equity or whatever. You're not going down that route. So, you're not offering a preferred return. That's one of the reasons why you kind of didn't want to go that route, because you have to, there's more reporting, they're kind of watching over your back all the time, breathing down your neck, whatever. So what are your returns that you try to, what's your minimum returns that you try to make sure that you achieve for your investors?
To track capital today, the most recent deals, in today's environment, it's 13 to 15 IRR. So, hopefully closer to 15. Most of these deals here recently at 15. So it's kind of really broken in two components. You got your cash on cash you're going to get along the way, and you got an equity multiple at the end when you sell it. So, most of these deals anymore, we used to always try to hit double-digit cash on cash yields. Deals, 4 or 5 years ago were all in the low 20s on the IRR projected, and reality they were all, I think our average on the deals we've sold 13 deals. I think it's north of 50. So we were thinking we're doing 20, and we delivered 55, and some higher, some a little lower, but over 50 average. That's just not reality today. Just not. So, if I could deliver a 15 IRR, the goal always has been double-digit cash-on-cash yields, and that's like next to impossible almost at this point. So, kind of most of these deals stabilize around a 9 cash-on-cash. And so, when I say stabilize, I think like year 3. Year 1's usually kind of 5 to 6. Year 2's kind of 6, 7, maybe 8. And then year 3 forward, we're hopefully trying to get to 9 plus cash-on-cash. And then the equity multiple, most of these kind of in a 5-year hold period, it's like a 1.75 to 1.8 multiple. So meaning if you give me $1 between the cash flow I give you along the way and the capital gain at the end when we sell it, $1 turns into $1.80 over a 5-year period. And so you average that together with impact of time. IRR is about a 15%. Probably your average annualized return is probably 16.5, 17, but you impact the time and cash flow, your IRR is about a 15 plus minus. So if I can get in that ballpark, we get capital attracted. If I'm in 12, I don't think I get, that much capital attracted. If we're above it, you just gotta kick them out because it's just coming throwing at you if you're 16, 17, because that's kind of the marketplace is a 14 or 15 today. And that's just kind of what it is.
So what are some of the best ways that you are structuring your deals to make sure that you're truly conservative? And conservative, sure. I say that, because there's a lot of people that say, oh, my deal is conservative. You're never gonna find anybody or hear of anybody that doesn't say that their deal is really conservative. And the truth is, once you dig a little bit further and you actually look at the numbers, you're like, man, this deal is like super aggressive. I don't know why this guy is saying that it's so conservative. So how is it that you are making sure that your deals are truly conservative?
Yeah. So if I was a passive investor, these would be some of the things I would look for. Is one, I feel like we do a pretty good job of buying at a value relative to current market, right? So then we try to find deals that we have some upside, both either through market or, more importantly, through our efforts by, renovating units or improving the management or whatever it is. So that's kind of first and foremost. And, so I think the first thing we look for, just, we're buying well-located stuff. So I'm not buying in high crime areas. We're not buying, basically not buying the hood, right? A lot of these people are taking risk on location and not really realizing what location they are, because either they don't live in the market, or they're kind of new to the market, or they just don't understand that, these deals that are the most vulnerable deals are the ones in the most high crime areas. So when everything's fine as long as the market keeps going up, but when it hiccups, no one wants to buy that stuff. So you don't want to buy in South Dallas in a high crime area when you can buy in North Dallas. If everything's on sale, the stuff in North Dallas has more liquidity than the stuff in South Dallas in a recession, right? So that's first and foremost. And then second to that, we make sure we have professional management in place. So we have, well qualified, third-party management's been around for 30 years. So they kind of are in place. Another thing I think people should do is make sure that, that you do good physical inspection on the front end, and you set aside enough capital up front to cure any sort of deferred maintenance that might exist, and then also implement your upgrade strategy. So whether you're going to upgrade the amenities like the office, pool, fitness center, stuff like that, and then, you can come in and swap out flooring and appliances and fixtures and kind of make a better product. To try to do that out of cash flow, that just doesn't work. So make sure you set aside the money up front so you're not undercapitalized and you can actually go out and do it. And then from there, just, a lot of the way you mitigate risk is just with your capital stack and how you structure it. So, if you're going to take a little higher leverage, I'm a proponent of taking longer term fixed rate debt. So if you're going to be 75, 80% levered, that's kind of a little bit more risky from a capital standpoint. You don't have quite as much equity cushion. So maybe you don't take interest rate risk. Maybe you take a 10-year fixed rate loan, and you do that. And I think that's kind of mitigates a lot of that risk. Or if you're wanting to put more of like a bridge loan or a floating rate loan, you should lower your leverage a little bit. So, maybe be closer to 65, somewhere between 65 to 70%. So maybe you do set at 25% equity, you do 33% equity and 67% debt, something like that. So about 1/3, 2/3 kind of ratio, maybe a little lower. So then if you do hit a little contraction, you have enough buffer that you can hopefully refinance it, regardless of what the economic conditions look like. So if you buy well-located deals, you properly put the debt on, proper level of debt, and either have it fixed if you have a little bit higher leverage, or lower the leverage, you take a floater, have proper management in place, have the proper capital, and don't buy on the hood. I think if you do those kind of things, that takes out 95% of the risk in these deals, in my opinion. And, it's a universal need. So, I think even the worst case scenario in Dallas-Fort Worth in 2010 was probably the worst year operationally for multifamily. I think most of the deals that were not super high crime area or distressed from like a capital standpoint, the worst it got was about 85 economic occupancy. So as long as you didn't have a super distressed situation where you didn't have enough money to make ready your units or stuff like that, or pay your employees, if you can sustain 85, that's about as bad as it got. And that was, hopefully once in a generation type of recession that we all went through. I can imagine the next one's going to be as bad as that one, but you never know, right?
You never know. Yeah. I like it, man. Thanks a lot for sharing those good points there. So it's time to shift gears here a little bit, Mike. So it's time for our Nuggets of Wealth, and these are questions that I'll ask you, and hopefully they can people can learn a little bit more about you, and also help themselves out with some of these answers. What is a good tool, source, or platform that you use almost daily that can also help others?
I think the best tool we have is Dropbox. I think we use that all the time. So we've always used it. So it's just kind of a centralized place to store all your documentation. When we first started out, we weren't very purposeful about it. And we didn't have it was kind of a mess, and we didn't have stuff kind of organized. So we went through a few years ago and got a chart of accounts. So everything's in the same file folder system by property. Everyone has the same files and subfolders and et cetera. So like I know exactly where to find copy of my settlement statement if I need it. I don't have to go hunt and waste 10, 15 minutes because it's not in the same order. So I think if you can get Dropbox and then organize everything and the same way by property, especially as you scale, that's been one of the better things. I use it both on my phone all the time and just sitting on my desk. I use it every single day.
Got it. Good. What was the best business advice you ever received?
I think one of the best business principles I've ever heard is what gets rewarded gets repeated, or what is measured is treasured. You kind of say the same thing. So I think really what you do is if you want to get someone to do something, you need to motivate them and then hold them accountable, basically. So if you motivate with either bonus or money, and then you have accountability and you're on top of it, those things tend to get done. If you don't measure stuff, you don't follow through, you don't track it, those are tasks that tend to kind of get pushed aside.
What are your rules for success?
I think what I do is, I on a regular basis, I'm guilty of kind of going down a rabbit hole sometimes and getting distracted screw down the internet or something. But what I try to do is every day I just make a list of the most important things I need to do that day and make sure that those are the things that drive revenue, that I focus on those things. I'm spending time. So, there's a lot of important things to do what we do in this business, but the way you make money is doing what I do for a living is you got to find capital and you got to find deals. So I got to spend the majority of my time, the highest best use of my time is either finding capital, dealing with my investors, or finding deals, working with the brokers, and everything else is sort of noise. So, it's all important. You got to execute. You got to buy the right location. You got to do underwrite it right. You got to do all these other things, but you can outsource a lot of that or have employees do a lot of that and kind of monitor it. But what I don't outsource is, talking with the brokers and talking with our investors. Those are kind of the biggest and best things I try to focus on every single day. So if I get myself going down some weird little administrative task, I try to stop myself and then get someone else to do it so I can focus on the bigger and more important things.
Like that. So you kind of touched on this a little bit earlier today. But where do you see your business in the next 5 years?
Yeah, I'm not quite sure about 5 years, but the goal is by the end of 2020 to be somewhere between 8,000 to 10,000 units. I think, right now I see us kind of hitting about 10,000 units and then kind of staying in that general ballpark and just kind of maybe trading this deal out for this new deal in. But, I got a feeling once I get there, we'll just kind of keep going. So I would imagine that if in 5 years from now, we'd probably be closer to 14,000, 15,000 units. I would want to get another market that we can go into at some point as well. But, right now we're, really kind of the goal also is hopefully by the end of this year, be closer to 1,500 units in Austin. Because right now we're low over 900. So I think 1,500 is a pretty good base there. So I don't know if we're quite there, but I'm sure we get at least one more in this year. So we'll crack 1,000 for sure. And, that's kind of a good base to make sure that we have enough scale to pay attention and focus on it and go down there on a regular basis.
Like it. So moving forward, will you be only focusing on multifamily, or will you kind of also shift your a little bit of your focus and attention to other asset classes?
Yeah. So as far as being an active investor, I don't foresee myself doing anything but what I'm doing right now. I don't, I think focus is powerful. So if I can just focus on one thing and just be, the master of this and this one type of asset and these, very select markets that you can know what you need to know and you can outperform. As we accumulate capital and I don't reinvest in the deal. I have invested in some oil and gas and some other stuff. And so far that hasn't gone as well as I would like it to. So I will, hopefully can find someone else in a different asset, a sponsor in a different asset class that I can trust that has a good track record. And I'll just passively invest with them if I want to get into oil or office or any other sort of other business. So that's kind of, it's going to focus on my core for the active activities and then, do what my passive investors do, find someone that's competent and successful at what they do and just kind of bet with them and invest alongside them.
I like that approach. And I think that's what, people definitely should do. Find somebody that's doing what they do and they're like a master of what they do and just invest with them. If you're, a proven, multifamily owner operator like Mike, he's not going to go over there and try to, perfect the office space or the mobile home park space. He's gonna invest passively with somebody else that's as a pro at what they do. I really like that. So why should somebody invest with you, Mike?
I think we first and foremost we've have a pretty good track record. And then we're, like I mentioned, I'm hyper focused as we just kind of talked about. I am a one trick pony. I just try to do that trick really, really well, right? So and we're I kind of consider myself, especially in Dallas-Fort Worth, like one of the ultimate insiders, right? It's a completely unfair business. So what chips you could trade, all those things. So the guys that have done a bunch of deals get the more deals, so it's unfair in that standpoint. So anyone that invests with us certainly can leverage our track record, our experience, our relationships, our ability to get debt. That's the other thing that's been completely unfair that we're able to get. Being a bigger sponsor, being to a more debt, the agencies tend to give you lower spreads and more interest only and more favorable loan terms relative to someone that's kind of newer in the business. So we can then get better debt pricing. So we then have better returns on the next guy. So it even further enhances our ability to buy deals because our economics are better than say maybe someone who has less than us. So that's been it. I think we do our best to try to be very consistent with reporting. We report monthly every single month, every single property. We do monthly distributions by ACH every single month. And then we try to be as transparent. So, it's a problem business, right? So, unfortunately, most of the problems are handled by the management company. Major problems get bubbled up to us on the ownership level, and we kind of handle all these problems. But having someone that can handle problems on your behalf and make the right decision, that's the one thing that experience gives you. Is every time when you first start out, you see your first time a tenant sues you over tripping and falling on your property or whatever it is. It's a very nerve-wracking deal, and by the 15th or 20th time it happens, you realize that, hey, I own enough apartments. Three things are going to happen: people will die on your property, there'll be fires, and your tenant's going to sue you. So if you can't deal with those three things, then you shouldn't be doing this business. And that is something that, when one of these three things happen, we have a procedure and protocol, and we have insurance in place, and we have all these things that it's just kind of second nature. So we just kind of deal with it as part of doing business. Where if you invest with someone that's a little less experienced, they got to stop everything they're doing to then try to figure out what the right move is, and they may or may not make the right decision in that standpoint. Now, when this happens, we just kind of react versus having to think, and deal with it. And make a decision that takes 10 times as long as what we can now. So those are some of the reasons. But obviously, whether it's with me or somebody else, you need to make sure that whatever your investment objectives align with what the type of deals that they're doing. And for whatever reason, an investment that anyone puts in front of you doesn't either feel good or work with your objectives or your timeline, there's always another deal. So I try to encourage people to make sure they're comfortable with it. If this one doesn't work, wait about a quarter, there'll be another deal, or 6 months, there'll be another deal they can come along and invest in. There's always another deal.
Yes. I love that, Mike. Yeah, thanks. So last question: at the end of your life, how do you want to be remembered?
Hopefully that we built a ethical company, that we did good. So what I like about this business is a feel good business. So not only if done well, we can come in, buy these deals, and make a bunch of money for ourselves as a sponsor and all our passive investors. We can also take care of all our vendors, our bankers, our management companies, all the other people that support it, as well as we go into a property that's generally sort of not working as well. It's a little bit broken. Through our capital, we fix it. We improve the management, so we improve the community by improving the asset there, as well as improve the lives of the tenants that live on our property by providing them better housing and safe and affordable housing. So I think it's a win-win-win type business if done right. So hopefully I can build a whole bunch of those and improve all the communities across North Texas that we invest in. I do my little part there, and then of course the taxing authorities come along and raise our property taxes. So we're helping all the school children of North Texas out by paying tens of millions in property taxes a year.
I listened to Mike's podcast, the Old Capital podcast. For those of you guys listening to this one, you definitely need to check out his podcast. Is by far my favorite, so I highly recommend it. But one of the things he and Paul always talk about is how Mike pays so much in taxes, and he's like so treated unfairly. The more tax you pay, the worse they treat you or whatever. It's so funny. It's just so funny.
But that's just part of it. We're helping the local economy tax base by paying our more than our fair share, I feel, in property taxes, and kind of is what it is. It's kind of part of the deal. But I think if we do it right, then that's good. And then hopefully at some point we can leave a legacy for the family and the kids, and through like you mentioned, our podcast. We try to give back by hopefully providing at least our perspective on stuff and kind of the market and current conditions, and hopefully we can help some other people that invest that maybe have getting a little bit started out, avoid some of the common pitfalls either that we've made or we've certainly observed. And I was the Grim Reaper 10, 12 years ago being a banker, so took a lot of those lessons that hopefully we can impart some of those nuggets upon other people that they can avoid some of these simple mistakes. So whether people listen to me or not, at least I tried.
Yeah. So where can Commit to Wealth Nation go to contact you or find out more about what you're doing? Maybe they want to reach out to you.
Yeah.
What's a good place to go and contact you?
Yeah, there's really two ways. I'm going to mention, you just mentioned our podcast. So I co-host the Old Capital Real Estate Investing Podcast with Paul Peoples. So you can find that on iTunes or Stitcher, or probably anywhere you're hearing my voice right now on Juan's podcast. You can probably find our podcast, or simply go to our website, which is oldcapitalpodcast.com. It says there as well. And then the company I run that I focus on is SPI Advisory. That's where we raise money and buy large scale apartment complexes. You can find more information by just going to our company's website, which is www.spiadvisory.com. That's SPI like spy advisory.com. There's a contact us form. You fill that out. I'm always happy to have a 10 to 15 minute telephone call with listeners off of podcasts that are potentially interested in working with us.
Awesome. Well, Mike, man, it was a true pleasure to have you on. I really do appreciate it. Your time. I appreciate it. All the information you gave us. Hopefully it's able to help out, not only, those active guys that are out there looking for their own deals, but also some of those passive guys that are like, hey, let me learn a little bit more about this. Let me see who this Michael Becker guy is and kind of like understand who he is and what his company does and, those kind of things. But, I think you definitely helped us out a lot. And so with that said, man, I really do appreciate it. And I wish you continued success.
Thank you, Juan. Appreciate it.
CommitToWealth.com, creating a legacy by committing to real estate wealth.